Hello, everyone, and welcome back to SALT Talks. My name is John Darcy. I'm the managing director of SALT, which is a global thought leadership forum and networking platform at the intersection of finance, technology, and public policy. SALT Talks are a digital interview series that we started in 2020 with leading investors, creators, and thinkers. And our goal on these talks is the same as our goal at our SALT conferences, which we're excited to resume here in September of 2021 in our home city of New York. But that goal is to provide a window into the mind of subject matter experts, as well as provide a platform for what we think are big ideas that are shaping the future. And if you've been a recurring listener or watcher of our SALT Talks, you know of our enthusiasm for the crypto or the digital asset space. And we're very excited to bring you our latest episode of our digital asset series with two fantastic founders and executives in that space. Those two guests that I'm referring to are Asiff Hirji and Kyle Samani. Asiff is the president of Figure, which is a blockchain-based home equity lender. And prior to joining Figure, Asiff was the chief operating officer and president at Coinbase. Prior to that, he was an operating advisor at Andreessen Horowitz, chief restructuring officer of Hewlett Packard, and served as the president and COO of TD Ameritrade. Asiff also held senior leadership positions at TPG Capital, Saxo Bank, Hewlett Packard, and Bain Capital, and has served on a number of public and private boards, including Citrix Systems. Kyle Samani is the co-founder and managing partner at Multicoin Capital, which is a thesis-driven investment firm that invests in cryptocurrencies, tokens, and blockchain technology. In his current role, Kyle helps identify market opportunities and sets the strategic direction of the firm. Prior to Multicoin, Kyle co-founded Pristine, which is an enterprise software company that enables deskless workers with solutions for smart glasses. And under his leadership as CEO, Pristine grew to millions in revenue and raised over $5 million in venture funding before being acquired by Upskill in 2017. Kyle is based in Austin, Texas, and holds a degree in finance and management from NYU Stern and has been programming since he was about 10 years old. Definitely way ahead of me on that one. But hosting today's talk is me. Again, I'm John Darcy. I'm a managing director at SALT, as well as a director of business development at Skybridge Capital, which is a global alternative investment firm with about $8 billion in assets. We also were the first 40 Act fund and the first fund of hedge funds to make a direct allocation into Bitcoin. And we currently have about $500 million of exposure into Bitcoin in our flagship products. But I want to start off, Asiff. I read a little bit about your bio, but I want to hear more from the horse's mouth. You were at TD Ameritrade. You were the president and COO. You also have worked at some of the most respected investment institutions in the world, Bain Capital, TPG, Andreessen Horowitz. What convinced you, as somebody that has this diverse background, that it was time to dive headfirst into the crypto space, into the digital asset space that you did at Coinbase and now at Figure?
Yeah, thanks for inviting me to this. Look, I've been an operator, entrepreneur, investor in fintech for over 30 years. I started, initially in things like direct banks and insurers. And I would tell you, I'm a software engineer by background, right? So to me, very simplistically, we've been to two waves, and we're now going to the third wave of innovation in financial services, right? The first wave was we went off mainframes and onto distributed computing, protocol-led, internet one, great businesses being built, including things like Ameritrade and so on. Basically, what we did was we made it self-service. We took things that you had to go into a bank or a teller to do, and we made them self-service on the internet with a web and with a web browser. And that lowered costs and increased inclusion, but fundamentally didn't alter the cost structure. The next thing we did was when we went from distributed to mobile cloud. And that made things like the phone ubiquitous. It made lots of different types of products available. Again, all you did was you took the application and shoved it further out towards the user, lowered some costs, but still didn't fundamentally attack the cost structure of financial services. We're now about to go to the third wave, and that's from mobile cloud to decentralized, right? And for the first time, or blockchain if you prefer, for the first time, we're actually affecting where the data is. The data is no longer on a central computer somewhere. The data is now distributed out to the users. You control your own data. Kyle controls his own data. I control my own data. And the fundamental thing that blockchain does is it gets rid of the intermediaries, right? The financial services system we have today is built such that you have to have a whole bunch of trusted intermediaries in every transaction, because that's the only way you can ensure that if I want to pay you, John, some amount of money, that my bank takes it from my account, sends it through the pipes to your bank, who then ultimately gets it to your account. And every single intermediary along the way there charges a fee, right? With blockchain, you can have peer-to-peer, bilateral, risk-free, real-time settlement. And that means I can send you money as easily as it would be for me to send you an email. As long as I have your address, I can send it to you, and there's no settlement risk, and it just settles. And that means that the cost structure crashes for financial transactions. And so that's why I'm excited about crypto in general, which is I think it'll fundamentally rewrite the way we do financial transactions. It'll make financial services more or less free. So this whole concept of the unbanked and underbanked will go away because you'll have financial inclusion. And best of all, you will be able to create this with far less capital being deployed, far less complexity. And you'll get rid of a number of the issues that we've had most recently with things like, say, the GameStop situation, or what happened with Robinhood, et cetera. None of those things can happen in a bilateral risk-free settlement mechanism that the crypto allows.
Right. And Kyle, you come from a programming background, an engineering background. What was your sort of eureka moment as a young man deciding that you wanted to make crypto or digital assets your career?
Yeah. So in early 2016, after I had stepped down from Pristine, I was kind of trying to figure out what I want to do next with my life. And I studied finance at NYU and had always had an interest in the intersection of software and finance. I started playing around with some of Stripe's APIs, which were, this is like February, March 2016. And I got, to the limit of them pretty quickly, which is basically Stripe made it really easy to, accept credit card payments as a merchant. And I remember I had some ideas I was fiddling with. And one of the ideas I remember I had is I wanted to do something where, as a user, I could go to a website and I could receive payment as a user quickly, like within, 5 to 25 seconds, depending on my identity or some action I conducted or something. And I just kind of assumed that, Stripe was like the payments company. They were, kind of top dog. I just assumed that Stripe made it really easy that as a consumer, you can get paid reasonably quickly. And what I learned real quickly after digging into Stripe's APIs is that that was wrong, and that even still to this day, as a consumer, if you go to a website, getting paid is very, very difficult. Paying is okay. I wouldn't say it's great, but typing in a credit card and paying is okay, but getting paid sucks. And I realized that limitation, and I discovered something called Ethereum, and it dawned on me quite quickly that with Ethereum, I could go to any website and I could get paid theoretically in seconds. And then I started kind of exploring what else you could do with Ethereum, and I realized it was kind of fully programmable, extensible money. And when that light bulb went off, it struck me as a very, very important kind of idea in technology. And so over the course of 2016, I started reading and learning about the space, and investing my own money and time. By the spring of 2017, I had developed a full-time internet hobby, and made the decision to do that professionally instead of just personally. And so made the decision to launch Multicoin in May of 17. We launched our hedge fund on October 1st of 17.
And we often come at these talks through the lens of Bitcoin as most people's gateway drug into crypto or DeFi, but you're not a Bitcoin first, evangelist within the crypto space. You're much more Ethereum first, and then obviously Multicoin. You guys are investing in a series of protocols. What did you like about Ethereum, and what didn't excite you about Bitcoin? And to this day, how do you look at sort of the differences between those two platforms?
Yeah. So there's generally speaking, a lot of the sources of confusion, both inside of crypto and among new folks who are getting into crypto, is the split between what I'll call the money crypto people and the tech crypto people. The money crypto people tend to have an econ background, and tend to be focused on kind of libertarian ideals of sovereignty and ownership, and government central banks inflating the monetary base and all those kinds of things. And those were obviously the first people to get into crypto because that's kind of what espoused Bitcoin. And the tech people have only gotten into crypto more recently, kind of building on top of Ethereum and now on top of some of the newer smart contract platforms like Solana and some other ones as well. I've never had a strong background in economics and never had dove into kind of the history of central banks and all those things. So the Bitcoin value proposition to me just never resonated. I knew what Bitcoin was in 2012. I just didn't care. Ethereum struck me as important because I understood that I could program money in ways that Stripe could not let me do. And it wasn't 10% better than Stripe. It was infinitely more extensible than Stripe. And so that's what kind of pulled me into the space. Since then, the space has evolved even more, and we can do all kinds of things that I couldn't have imagined then. And now these systems are becoming fast and scalable, and we're kind of seeing the next wave of things that you can do that are truly crypto native, things like social tokens and NFTs that weren't even conceivable a few years ago.
Right. And also,
let me offer a perspective on that. Yeah. So I was one of the original Bitcoin believers, and I still am. And that's what got me into it. And I would tell you that, as a software programmer, and I do have a finance background, but whoever he, she, or they were, Satoshi solved one of the hardest problems in computer science, right? It was how to do distributed trust. And when I was at Watson Labs way back when, this is one of the issues we used to try and beat our heads against the wall against, and we couldn't come up with a solution. They came up with a solution, and it's pretty ingenious. But more than that, they showed a way to build an application such that the data is decentralized, right? That's the fundamental breakthrough. And all the other things that came along, whether you're an Ethereum believer or Solana, whatever, it doesn't matter, right? They would not have been possible without Bitcoin. And I would argue, and maybe this is not a popular point of view, crypto can't succeed if Bitcoin doesn't. And that's because the Bitcoin, if you think of crypto for the average person, if you said crypto, they would think Bitcoin. They don't think something else if they think of crypto at all, right? And to have the single largest asset in the space, the one that the start of the space, then fail is not going to be helpful for the industry, right? It's not like the internet where you could say, oh, AOL introduced the masses to the internet, and then it's okay that AOL failed because we had the rest of it come along. It's not the right, to me, it's not the right analogy. So a couple of things in my mind. One is Bitcoin is super important. It solved one of the biggest problems and showed us how to build applications in a way that we hadn't thought of before. I believe it's a store of value. I believe it'll continue to innovate with stuff being built on top and beside it. But I think that it has unleashed all the other innovation that Kyle is talking about. We wouldn't have had NFTs. We wouldn't have had all these other things without Satoshi and whoever he, she, or they were, having created the breakthrough in the first place.
Right. And also tell us about Figure. So you were a president and COO at Coinbase. You were responsible for a lot of early to mid stage growth. You left prior to the direct listing, but you were responsible for a lot of the growth there. And you probably had your pick of the litter in terms of where you could go next in the space. You chose Figure. Tell us about what Figure is and why you chose that.
So I go back to, I really think that blockchain or crypto should be fundamentally rewriting the way we do financial services. And it is, if you look at DeFi, but DeFi is aimed at people who are already long crypto. Like DeFi is bringing traditional financial services products to people who are already long crypto. It is not showing people like you and I and others who are using traditional financial services how to use crypto to do those things better, right? Do you understand the difference, right? Yep. So if you're long crypto, DeFi is great. If you don't have crypto at all, so far blockchain has had no impact on you at all, unless it's a speculative asset class. And for blockchain or crypto to be successful, it needs to be as ubiquitous as the internet, right? We shouldn't be able to imagine living life without it if that's really going to be successful. So one of my biggest frustrations at Coinbase was that most of the projects that came to us, while they espoused that they were doing something to in financial services for the masses, et cetera, what they really were was token speculation. They when you got right down to it, they really weren't doing anything real. And so I went looking for who is using blockchain to at scale make financial transactions, everyday financial transactions better. And Figure was the only company I found. And what Figure is doing is it takes very simple financial transactions that we do every day. Like I want to borrow money to buy a house, or I want to borrow money to pay off my credit card, or I want to make a payment to a person, et cetera. And it's built how to do them on blockchain. So it's taken these really immensely complex, capital-intensive processes and boiled them down to things that happen in minutes with minimal capital requirements. And we're not doing it because we're trying to be the biggest lender in the world. We're trying to we're doing it to show the lending industry it can be done. And we're able to originate mortgages at double the margin of any other provider in the space. We're able to do home equity lines of credit instantly, whereas it's normally a 45 to 60 day process. And now we have, the largest players in the space looking at our technology, wanting to adopt it. And that's what we're after. We're after them trying to adopt it and bring out the solutions to the masses with lower capital and much lower costs That's the promise of crypto, and that's what we're trying to push.
So why did Figure start with home equity lending as a product? Was it
right.
Proof of concept in order to expand to a more institutional audience and demonstrate that proof of concept?
Yeah.
Why did they start there?
So we needed something that had both sides of the market, right? We needed something that the consumers needed and that the financial markets would then buy. So there's you could choose a lot of things. And then we wanted something that you could actually control end to end to begin with. And so a home equity line of credit is actually a good product that way. In the original, if I was traditionally a lender like a SoFi or whatever, I would originate, say, $100 million worth of these loans. And then I would go to the market and say, I want to securitize this. I'd get a whole bunch. I would represent what that package looked like in terms of FICO scores and loan to value and geographic distribution. I get a bunch of bids. I'd pick a winner. They would hire an auditor. They would audit my loans. 60 to 90 days later, the transaction would finally settle. In the meantime, all my loans are tied up and capital is being consumed. The buyer got their capital tied up. Hugely expensive process. We don't do any of that because when we originate a loan now, we get the credit score company to stamp the score to the blockchain. When we get a valuation, we get the valuation company to stamp the valuation to the blockchain. There's no more auditing anything. You as an investor can sit there and say, hey, I want California, I want CLTV less than 80, I want FICO over 720. Only the loans that match that show up. And because we're replacing trust with truth on the blockchain. And if you want them, you can bid on them in the open market and you buy them. And so we've turned a 45 to 90 day capital intensive process to a capital in advance of origination process. It's got capital light. And that's just in one product.
Yeah, it almost reminds you a little bit of the early days of Amazon, where Jeff Bezos chose books as his proof of concept. Okay, I'm gonna master the logistics around delivering books, the commodity that everyone knows and likes. And then once I do that, I'm gonna expand this technology to a whole different suite of products.
Exactly right.
So Kyle, at Multicoin, you guys do multiple things. You invest into liquid tokens, but you're also investing into projects built on top of a lot of the blockchains that you're investing in. What are some of the most compelling use cases you've seen? In addition to talking about something like Figure, what are other really interesting use cases you've seen for blockchain-based applications?
Yeah, so I'll touch on an example here that's very real world and tangible, and then if you want, we can go into some of the more abstract, weird, kind of less tangible things. So we're the lead investors in a thing called Helium, and Helium is one of our largest positions, and we're super excited about it. Helium is a new business model for deploying and managing wireless networks. So what does that mean? If you think about Verizon or AT&T today, or any of those big telecoms, right? They're extraordinarily capital intensive. They have to go, identify where they want to have towers. They have to rent the land. They have to work with tower companies. They have to work with city governments. They have to hire armies and armies of people, get them trucks, get them a bunch of hard hats and equipment. They drive around. They, install all this equipment. They run a bunch of backhaul. It's extraordinarily capital intensive, and they have to do it at large scale. Like doing one city alone is not enough because people expect their phones to work wherever they go.
Right.
So you have to do, large geographical coverage. The only way to do that is to then, raise a tremendous amount of debt financing and then lock in your customers into 2-year contracts. So you have some guaranteed revenue that the debt underwriters will, lend against, basically. And it's obviously very kind of centrally coordinated and top down. Helium is basically the exact opposite of that. The vision in Helium is any Joe Schmo at home, either consumer in their home or small business owner, can buy a hotspot just about yay big, plug it in the wall, in their window, put it next to the window, plug in electricity, plug in Ethernet, and then create radio waves. And any device walking around nearby can access those radio waves and pay per byte of data. And if you think about this model, you take the two largest sources of cost, which are labor and land, and you send both of those costs to zero. You just outright remove those costs from the system. And so this is really kind of disruptive to the cost structure model of telecom. We were fortunate to lead the last round in Helium in 2019, and they started rolling out the Helium network later in 2019. Today, there's over 60,000 hotspots live around the United States and Western Europe and China. Another 500,000 hotspots have been back ordered but not yet shipped. And you just see this network really rolling out. And so this is the kind of thing that we're really excited about, is using these decentralized technologies as a way to incentivize people all over the world who don't know each other, don't trust each other, to all do some collective action and produce some net positive result, as a result of that coordination. And the best part of this whole system is the whole thing is not centrally owned and managed. Helium Inc. could go out of business today, and the blockchain would keep running, all the system would keep running. It's a truly decentralized system, and that's the kind of power that that is the new kind of crypto-enabled business model that we think is super exciting. That just, you can't map this to the traditional, Web 2 type business models at all.
It's fascinating. So now I want to hear your weird abstract application.
Yeah. So, look, DeFi is kind of the first segment of that. As Asiff noted today, this DeFi ecosystem has a fair bit of press coverage. There's call it $50 billion or so of capital kind of sloshing around in it right now. It is circular. The DeFi ecosystem is mostly people levering up to speculate on more DeFi things. That is okay. That is not bad in and of itself. That is just kind of, it's the Wild West. And the first thing people did was take leverage, because that's what people do in financial markets. And what they lever up on is they levered up on other DeFi crypto things. But now they're proving that this stuff works, and you're going to start to see it expand into more regulated institutional offerings over the next few years. So DeFi is kind of section number one. I won't harp on it too much more. I think some of the newer kind of cutting edge areas that we think are super interesting are things like social tokens and NFTs. And I think these things go together in some interesting ways. Right. Social tokens are my kind of favorite thought area at the moment. What is a social token, you may ask? There's no kind of strict definition, but I'd say loosely, the idea of a social token is having a token that is in the name of a person or of a group. So it could be Kyle coin or Asiff coin. It could
Salt
be
coin.
Huh?
Salt coin.
Salt coin.
Could be Salt coin. You can kind of whatever. You can have David Guetta coin. You can have Red Hot Chili Peppers coin. I don't really care. Right? Pick your entity or organization that today doesn't really have a asset that represents value and or utility around them, and give one of them to those people. The obvious thing you're going to say is, what do you do with these coins? And the answer today is, I don't really know. But I do know that people are creative, and they're going to do all kinds of weird, wacky stuff with them. And I do think it's going to become kind of a normal part of society where it might not be everyday people. I don't know if my mom is going to have her own coin. She probably doesn't care. But I think for anyone who has kind of a public presence on the internet, this is just like everyone has an Instagram or a Facebook or a Twitter. It's going to be kind of just become part of the public discourse on kind of internet society. And creators and celebrities are going to do interesting things with their coins. So the obvious things are like, hey, if you own X number of coins, you can get lunch with me. You get access to movie premieres and stuff like that. Those kinds of things are relatively obvious and will happen over the next 6 to 12 months. I think there's going to be a bunch of creators, though, that start to do really interesting things. Like, for example, these TikTok hype houses. I wouldn't be surprised if, those creators, you get 3 of them and say, look, if you own X number of each of our coins, you can come be in our next TikTok video. And you can use that to launch your own kind of TikTok career, and then, develop your own brand identity from there. Right. And the way that these things are going to get remixed, I think is just going to be super interesting and fascinating. The design space for social tokens is incredibly broad and interesting, and is going to unlock kind of the intersection of human creativity and finance in a way that's just never intersected before.
So Asiff, going back to Figure, you guys demonstrated the use case for blockchain technology with this home equity product. On March 11th, you had your first securitization. It was an ABS securitization. Maybe prior to that, banks were saying, oh, this blockchain thing sounds kind of interesting, but do we really need it? We have traditional databases. We have traditional ways that we, gather information about the underlying loans and assets and then the securitizations. Did that trigger some, sort of aha moment for banks that's led to a different level of interest? And let's say, for example, we had Figure during the global financial crisis or prior to the global financial crisis. How would Figure have changed the way we analyzed different securitized products, and would it help prevent potentially the crisis?
No, two really good questions. So the securitization was a milestone, and third parties went and looked at it and said, hey, compared to a regular securitization, not including the ratings, which is even more expensive, right? This saved over 120 basis points compared to a regular securitization. Now you think about how big the securitization market is. 120 basis points on that is a very, very big number for the industry, right? So we got a lot of interest in that. And it's just some of the very basic things that are different, right? So if you're using blockchain, like for a normal company originating loans, running a warehouse, right? You warehouse loans before you get ready to securitize them. If I've got a provider of the warehouse, that provider of the warehouse has 3 to 5 people managing the exposures in the warehouse to make sure I'm not overrunning the geographic distribution I'm supposed to be in, or the FICO scores or whatever. And I've got 2 or 3 people doing that. We have none of that with blockchain. It's a smart contract. The smart contract basically says, here are the rules that govern the warehouse. That's it. That's, you can't, if the rule set is right, you can't overrun the warehouse with stuff that you're not supposed to. And so those 3 to 5 people go away on both sides. It's just one very simple example. And so we got to the point where when we originally started, we had hedge funds as the primary buyers of the loans we were originating. Now it's major banks, credit unions, and pension funds who are the major buyers of all these things. And secondly, it was hedge funds that were providing the financing. Today, the financing is provided by the Wall Street banks, all the big ones, including JP Morgan, right? If you had said 2 years ago, Jamie Dimon's bank, who said Bitcoin was a sham, was providing a warehouse on blockchain, people would have laughed you out the building, right? But that's what they're doing. So that's what's happened in terms of the adoption. And to your second question, because the servicing data is all, again, on blockchain, our servicing data is real time, and it's real time available to anybody, right? As long as you have the loan ID, you can look up the performance of the loan real time. And so when we had the COVID correction just over a year ago, we actually had hedge funds who were buyers of our loans using our real-time data to look at the performance. They were using it to arb MBSs on the market because they could see how well our loans were performing relative to others. And by the way, our loans were outperforming first lien Fannie, right? That's how well they were performing because we had the real-time data and we're able to manage them in real time. And so again, you go to a blockchain-based system. It is less capital consumptive. It is much more real time. It is higher, therefore, credit quality and higher credit performance. There's no reason to not do it this way. And
right.
That's all we're trying to do. We don't go in saying to people, we have a blockchain-based system. Are you interested? We go in and say, we have a system for loan origination, sales, and service that saves you over 150 basis points, is real time and requires less capital. Are you interested? It just happens to be on blockchain.
It's an example, the COVID correction that really resonates with us at Skybridge. We had heavy exposure to the structured credit space. That entire market broke down on a technical basis.
It froze. Yeah.
All these intermediaries and one, decides to do something out of the ordinary and it freezes the entire market. So, we are very transparent with our investors. We're marking things to market. The entire market froze. So we're telling people, our assets are marked down 25%. Fundamentally, they're not impaired. We don't think really at all, or definitely not to that extent. But if you remove all those intermediaries and you create a more efficient, transparent system, you make a lot of people's lives easier, including ours, when communicating to clients around March, April of 2020. But Kyle, you talked about how you really got jazzed about crypto through Ethereum. You said, "Wow, this is taking what Stripe has done with its API and putting some leverage onto that." But there's other blockchains that compete with Ethereum. Ethereum obviously has created tremendous network effects and has become the go-to platform for NFTs and other tokens. But there's other blockchains that are out there, doing similar things that in a lot of ways might be more efficient or better constructed. What are some other competing blockchains with Ethereum that you think stand out?
Sure. So we've been kind of loud public investors in a blockchain called Solana. We've been early investors since they started R&D back in early to mid 2018. The Solana network has been live now for about 16 months or so. The reason we've been so excited about Solana is they have from inception been focused on 2 things. 1, enabling on-chain limit order books, and 2, really focusing on scaling these systems. One of the interesting things out of Ethereum is the market cap of Ethereum today is 250 billion plus or minus. And the number of daily transactions on Ethereum is about 1.5 million. So if you just think about that math, like of any system, whether it's Facebook or Twilio or Uber, whatever, any of these systems,
yep.
The market cap per daily user on Ethereum is truly like it's a totally different level. It's very, very high market cap per daily user. Now, these things aren't apples to apples comparisons because they're obviously different than what they do is different. So you can't rely too heavily on a direct comparison, but they really, the number of users there is actually a lot smaller than you would think given the hype and given the market cap. Our theory has been that you have to scale these things to get you to 500 million daily users plus. And the Solana team has provided the most, I think, credible alternative approach to scaling these things, where you can write code now and know it's going to work in 6 months and in 18 months and in 24 months, and you know how it's going to scale. And so we've kind of made a big bet there. And in the 15, 16 months since this thing has been live, we've seen a number of pretty interesting developers kind of take advantage of this. And the most notable of which is called Serum. Serum is a new order book. It's a decentralized exchange. It's conceptually similar to Coinbase or FTX or any of these other things, but it runs natively on a blockchain. If you think about financial markets, look at equities, look at FX markets, look at commodities, look at any of these things, the way that all of these liquid assets trade is they trade on order books, right? You got market makers quoting spreads and quoting liquidity, and obviously adjusting their prices as new information comes out and whatever. And that's how finance works. And there's a reason that it works that way, because it's the right kind of way to price assets. The challenge in Ethereum has been because of the throughput limitations, you just can't run an order book on Ethereum, and everyone has kind of agreed that doesn't really work. And Solana has been architected with that. What that was the goal from inception was to run an order book on chain, and they've now proven that's possible. It's not as performant as the Nasdaq or New York Stock Exchange, and I don't want to claim that it is, but it's close enough that you can get global permissionless order books for any arbitrary asset, and that works now. You can see it live now, and that's already trading, $50 to $200 million per day on Serum right now, and that's been growing at a nice steady clip. We really think that the key primitive of having an order book available is going to be the most important kind of financial construction as we think about scaling these systems to billions of people.
Right. Asiff, I want to go to payments. So,
yep.
As we've talked about, Figure started, with HELOC loans and use that as a proof of concept, and has gone out and done securitizations now and is getting heavy institutional interest. But it also has ambitions to solve this blockchain for payments issue, which is one of the holy grails for the industry, about how to really potentially move off of those Visa, MasterCard rails to deliver point of sale credit. Could you explain to people who are less familiar what that means, what the implications of that are, and whether it is realistic to move off of those traditional credit card rails, and why point of sale credit is a better solution?
Yeah. So look, if you and I walk into a merchant and we take out a credit card and swipe it, there's actually at least 7 or 8 intermediaries who take part in that transaction between my paying for something and the merchant receiving the money that I'm trying to pay them and me receiving the goods. Okay. And again, each of those intermediaries takes a cut, and the poor merchant, depending on the size, is paying somewhere between 100 to 300 basis points on that transaction, right? It's super expensive. And most of the merchants are paying at the upper end of that, in terms of the fee. And a lot of that goes to back to the complexity that we've built into the Visa MasterCard system. And not only is it really expensive, but the way Visa MasterCard works, because it's a credit product, I, the merchant, am not actually guaranteed that I'm getting the value for the transaction, because the consumer can claim that there's fraud or something else, and then I get a chargeback, and so it's a hideously expensive process for the merchant. Okay, studies show that a merchant on $100 is maybe clearing something between 87 and 95, depending on what they're doing and how often they get charged back, et cetera. So, go back to, what does blockchain do really well? Blockchain does real-time bilateral settlement between 2 parties, no intermediaries, right? So if I went into the merchant and I could pay with stablecoin into their wallet, from my wallet to their wallet, settles instantly. There is no risk anymore that there's going to be a chargeback. There is no fee other than the blockchain processing fee itself, which is, orders of magnitude lower than the 300 basis points that Visa, MasterCard, et cetera, are charging that merchant. You take just a tremendous amount of cost and complexity out of that system, right? So we have built a service we call Figure Pay, which is a challenger bank. So think, Chime or Dave or whichever your favorite is, meets buy now, pay later. So something like a firm, meets merchant acquisition. So think Square, right? So it's got a card. You can use it at any merchant, but if it's a Figure Pay merchant, it's not the 300 basis points. It's more or less free. and it uses QR codes just like they do all over Latin America and China. It's running entirely on blockchain. And if you're a fintech, not only can you leverage this product to offer payment services to your customers, but you can also offer banking services because the core banking functionality is provided by the blockchain. There is no core, right? So if you're a bank, one of the biggest costs you have is your core banking system, which is probably antiquated, written in COBOL 15, 30 years ago, right? And all of that goes away using blockchain. And so we have 4 or 5 of these businesses, lending being the most mature, pay being somewhere in the middle, and we have some that we're incubating. Pay is now getting traction, kind of like lending was, say, 2 years ago. Lots of banks looking at it, lots of fintechs looking at it, lots of retailers looking at it as a superior way of providing that merchant acceptance, credit card type functionality, also banking functionality to customers, again at a much lower cost, all over your smartphone, all on blockchain rails.
Yeah, and we're investors in Chime and Klarna, so we understand that story intimately well.
Right.
So I want to talk about regulation. So Elizabeth Warren, everybody on Wall Street's favorite senator, she's both anti the establishment, too big to fail financial system, banking system, but she's also been a sort of loud critic of crypto, of blockchains. She recently issued a letter to SEC Chair Gary Gensler saying, by July 28th, I don't know how she picked that date, I need to have answers on how we're going to regulate crypto. Are you concerned? I'll start with you, Asiff. Are you concerned about regulation being this existential threat to the development of this crypto ecosystem and blockchain technology and cryptocurrencies? Or how do you see regulation in the United States shaking out?
So I think regulation is a big risk. I think you look at what China's doing with fintechs that are listing in the US, let alone anything else, and the Bitcoin hash rate. If the regulators really are serious about lowering costs and increasing financial inclusion, and that's what they claim they are, if they're serious about that, they have to be pro crypto. I believe the reason that they're not pro crypto is because they don't understand it and they view it simply as an asset class, which is the wrong way to think about it.
Right.
And not only an asset class, but a highly speculative asset class, which will only end in their minds badly for most investors. And so that's why when I was at Coinbase, we started a bunch of things that tried to educate regulators and educate our legislatures about what crypto is and what it can do. And that's making, those things are making progress slowly, but they're making progress. And so I believe there is a mismatch between the level of understanding within regulators and their perception of what crypto is versus where crypto is actually trying to go. Are there things in crypto which are scammy? Yes. Right. Will some people lose their money? Yes. But that doesn't mean that all of crypto is scammy or that there is no real value underneath it. And for a lot of what we do every day, there is a better crypto solution that is lower cost and will drive more inclusion for people who are currently excluded from the system.
Kyle, when you're evaluating investments, whether it be in liquid tokens or companies that are developing on different blockchains, how do you evaluate regulatory risk, and what's your outlook for regulation in the U.S.?
Yeah, so kind of building on Asiff's comments here, it's definitely a real risk, and there's no one in the world who can forecast how the political winds are going to change, both in the executive branch as well as in Congress, and how that's going to kind of filter into the SEC, the CFTC, and other regulatory bodies. Those things are actually impossible to predict on any medium to long term horizon. I would say, though, I'm just generally an optimist. If you look back at the history of the internet, there's been a lot of moments where people thought it wasn't going to take off, where the CIA, I think, or the NSA tried to ban encryption, right? There was that whole debate. There's been others over the years. If you look back at the early history of Bitcoin, say circa 2010 to 2014 or so, there were a lot of real concerns that governments were going to just shut this thing down as a threat to monetary systems and stuff. And actually now it's being, in a meaningful way embraced by a number of governments, US and others. And so I'd say I'm just generally a techno optimist on most of these things. And I think specifically, if you look at just the wealth creation and obvious lifestyle creation of software and smartphones and computers over the last 25 years, literally everyone in the world kind of understands just how powerful that force has been. And so the waves of I think general kind of interest is in letting innovators innovate and do things. Obviously, some folks like Senator Warren, like to yell things on national television, but I'm generally quite optimistic that's not going. It may cause some bumps here and there, but I don't think it's going to present an existential crisis of any form.
Do you think? Do you think it's a Bitcoin issue, but it's also a broader issue for crypto that China has now basically completely exited the entire cryptocurrency experiment? They've said, you know what? Well, at least decentralized cryptocurrencies and blockchain technologies. With the DD listing issue that you referenced earlier, Asiff, they're becoming very paranoid about data, and so they want to control every bit of data that passes through that country in and out. And so, they're obviously going to prioritize the digital yuan. Do you think China's sort of adversarial stance towards crypto is going to hamper development of the space? Asiff, we'll start with you.
So I think that there's, just like every technology, right? There are 2 ways or 3 ways you could use it, some of which are not great. And China is showing us that there is a dark side to crypto, which is you can use it to further the totalitarian state. Right. So should there be central bank digital currencies? Maybe. All right. Maybe. But China's basically said our currency will be digital because that lets us further enhance the surveillance state, because now you cannot get the fiat unless you have a digital wallet and I issued it to you. So the Chinese government, know exactly who you are and I can track everywhere you spend it. And if I don't like what you say or what you do, I can block it. Right. Now, that is kind of the evil twin, if you want to think of it, of crypto in almost every sense, because crypto is trying to be decentralized. It's trying to empower the end consumer. It's trying to give data back to people so that they can control the privacy settings of it, et cetera. But that same technology is being used in a very different way in China. My guess is that we'll continue to. There's been more and more sort of technological separation between the West and China, and I personally believe that will continue. I don't think it's a threat to Bitcoin or Ethereum or any of the other projects that we've mentioned here on this show, but I do think that it's a very different application of the same technology with a very, very different outcome, which is not great for humanity at that point.
Kyle, how do you look at the China issue?
It doesn't impact us in a meaningful way on a day-to-day basis. They've shut down mining is the big thing that's happened. Motivations are, a fewfold, but it's not as, I think the most cynical interpretations are overstated, at least of that particular action. It does feel like China is generally moving towards a kind of, surveillance state, Orwellian future. That seems to be happening. Although I don't take it for granted that is actually the outcome that we're going to get. Although it's a reasonable probability outcome. When we think about crypto and the opportunity in China, there's kind of 2 angles we think about. One is developers and the other is users. Most developers who are building kind of novel crypto things who are based in China are leaving China just for kind of personal safety reasons, which is pretty smart thing to do. A lot of them go to Taiwan, Singapore, Hong Kong, pick your locale nearby. And that's pretty common. And so that doesn't really create a problem for us as a firm. The other question then, of course, is users for these things. If you look at who is using DeFi today, it's actually overwhelmingly not Americans. It's overwhelmingly people in Asia. Southeast Asia is a massive market. It has almost no press coverage in the United States. China is a massive market. And the reason is because a lot of these people in these countries are trying to opt out of their fiat systems and of their payment rails that they are more or less subject to from birth onwards. And so those people are very interested in experimenting with these technologies, trying them, figuring out what they can and can't do, so they can opt out of the local regimes. And given what we've seen there in the last few years, I'm quite optimistic that will continue to be true. It may become more, legally risky for folks in China specifically. Unclear exactly how that's going to play out. But there's just across Southeast Asia and China, you've got, call it 2 billion or so, 2.5 billion people who, for the most part, are trying to opt out of their local financial systems, and that market is just astronomically large. And so we continue to spend a large percentage of our time and energy both understanding what developers are doing there, as well as understanding the way that consumers are using these technologies in China and elsewhere.
Right. Well, Asiff and Kyle, it's been a pleasure to have you on. We'll leave it there and save it for your next appearance. Everything else we could talk about here today for your next appearance on Salt Talks. We hope that you'll be able to join us in person September. We're bringing back our in-person SALT conferences in New York. There's also the Blockworks Digital Asset Summit going on at the same time. So we're excited to have just a really large ecosystem of players in the space and from the institutional world. We're somebody that's a newer entrant into the space from a Skybridge perspective. Really excited about all the potential that it holds. And like I mentioned earlier, Bitcoin has sort of been our gateway drug, and we're excited to be involved alongside the things you guys are doing in the space. But thanks so much for joining us here on Salt Talks.
Thanks for inviting us, John.
And thank you, everybody, for tuning in to today's Salt Talk with Asiff Hirji from Figure and Kyle Samani from Multicoin Capital. Reminder, if you missed any part of this Salt Talk or any of our previous Salt Talks, you can access them on our website on demand at salt.org/talks. Or on our YouTube channel, which is called Salt2. We're also on social media. Twitter is where we're most active. We're at Salt Conference. But we're also on LinkedIn, Instagram, and Facebook as well. And please spread the word about these Salt Talks. We love educating people, especially on the topic of crypto and digital assets. So again, share this episode with your skeptical uncle when it comes to crypto. On behalf of the entire Salt team, this is John Darcy signing off from Salt Talks for today. We hope to see you back here again soon.